After going through this module, we will be able to learn about the first, insurance companies and types of insurance, principles of insurance. Secondly, we'll learn about history of insurance in India. Thirdly, we'll learn about Insurance Regulatory and Development Authority, and then we learn about what is insurance solvency and e-insurance, etc. Finally, we'll learn about few recent changes and warnings and penalties in insurance sector. Insurance is very important industry in India. Insurance industry is relevant from both economic and social point of view. Since liberalization, insurance industry has gone through so many transformational changes. Liberalization has allowed the foreign insurance companies to enter into India. These foreign insurance companies see India as potential market. There have been several operational innovations and product innovations in the field of insurance business. Insurance industry manages risk of the society and also works as financial intermediary and provides long-term funds for infrastructural development of the nation. Now we move on to the insurance companies. Insurance is transfer of risk or loss of one entity to another entity in exchange of money known as premium. Insurance companies are into the business of insurance. Insurance companies work as a financial intermediary. These companies collect funds from society as premium and invest these large amount of premium in large development projects. Through insurance, these companies manages risk of the investor, provides means for accumulating savings and reduces investors' income tax liability also. On the other hand, the insurance companies provide funds to the government and other sectors for long-term projects. Insurance companies receive steady and periodic payments of premium as inflows. Moreover, liability of these companies is long-term in nature. Hence, they are having ample amount of funds with them. Mostly insurance companies invest their funds in government bonds, state and local government projects, mortgages and corporate bonds. Now we move on to principles of insurance. There are many types of insurance and many insurance companies. All these insurers have to follow certain basic principles of insurance. These principles of insurance are as follows. First, principle of insurable interest. There must be a relationship between the insured and the beneficiary. Secondly, principle of utmost good faith. The insured party must provide true, accurate and full information to the insurer. The third principle is principle of indemnity. Insurance contract is for providing protection to the insured party against risk and unforeseen losses. It is not for making profit by the insured party. Fourth, principle of contribution. Insured can claim the compensation from all insurers or from one insurer only to the extent of actual loss. The fifth, principle of subrogation. After compensating the insured for the loss suffered by him on his insured property, the ownership rights on such property shifts to the insurer. The next sixth principle is principle of loss minimization. In case of any uncertain event of mishappening, insured must always try to minimize loss of his insured property. Now, the seventh principle of insurance is principle of causa proxima. As per this principle, if there is more than one cause for the loss occurred, then most near of proximate cause should be taken into consideration while deciding the liability of the insurer under insurance contract. Principle of causa proxima does not apply to life insurance contract. These principles help to maintain integrity in all the insurance contracts. In the absence of these principles, people may use insurance process to gamble or speculate for any uncertain future event. Now we are moving to types of insurance. Insurance is mainly of two types, life insurance and general insurance. Under life insurance, insurer pays certain amount of money to the insured or his beneficiary upon occurring of a certain event such as death. On the other hand, any insurance policy other than life insurance are covered under general insurance. General insurance include health insurance, fire insurance, marine insurance, property insurance, rural insurance, vehicle insurance and travel insurance, etc. Now we move on to the life insurance policy categorization. In this we have different types of policies given by life insurance. The first is whole life plan. A policy which covers entire duration of insured life is known as whole life policy. In this type of policy, annual premium is paid throughout the policy term period. The second type is life insurance policies endowment. Under endowment plan, lump sum amount is provided when the policy matures or when the policy holder dies. There are few endowment plans which provide payment in case of critical illness also. The third type of life insurance policy is money back policy. Under money back plan, instead of getting lump sum amount at the end of the term, insured person gets a fixed percentage of sum assured at regular intervals. There is benefit of liquidity in money back policy. The fourth type of life insurance is term plan. Term plan are the most simple and cheapest type of life insurance policy which provides coverage for a specified period known as term or until a certain age of insured receives. If the insured person dies within the coverage period, then this policy pays the face amount of the policy, but nothing is paid if insured continues the term of policy. After the end of the term period, policyholder has an option to discontinue the policy or to extend it. The next type of life insurance policy is unit linked insurance plan. Unit linked insurance plan is a combination of risk cover and investment both. These policies are flexible and protective both at the same time. Premium paid under these policies are used to purchase investment asset units. These asset units are selected by policyholder. Now we move on to general insurance policy categorization. Under general insurance of non-life insurance, following types of insurance are covered. The very first is health insurance. Health insurance covers all the medical and surgical expenses incurred by the insured person. These plans are created after assessing the insured person's current health position. Then estimation is made for future healthcare expenses for the insured person, and after all these approximation premiums are decided for the policy. Second type of policy is accidental insurance. An accidental insurance policy covers both any sort of disability arising from accident and death due to accident. Accident should not arise due to the usage of alcohol or drugs. The third type of general insurance policy is property insurance. Risk to property arising out of fire, theft, burglary, and weather damages are covered under property insurance. Property insurance are further subdivided into earthquake insurance, flood insurance, and fire insurance, etc. Then we have vehicle insurance. Vehicle insurance is also known as motor insurance and auto insurance. It is a mandatory policy which should be taken by every vehicle owner. In case of auto accident, this policy mitigates the cost associated with accident. Vehicle owner has to pay annual premium to insurer, and then insurer pays full or part of cost arising on the auto accident. The next type of general insurance policy related to rural insurance. Rural insurance is a policy which covers the risk of agricultural and rural businesses. These policies cover natural calamities, livestock, crop, health and life. One can take policy according to his needs. The next type of policy is home insurance. Home insurance covers private homes from any kind of risk and losses. The next type of general insurance policy is travel insurance. Travel insurance policies cover both domestic and international as well as short and long distance travels. These policies cover trip cancellations, medical expenses, flight accidents, lost luggage, and any other kind of loss incurred while traveling. The next type of general insurance policy covers group insurance. An insurance policy which covers a particular group of people is known as group insurance. This group can be a society, employees of an organization, or members of a professional organization. The next type of health insurance policy relates to retirement insurance. Retirement insurance is also known as pension policies. Pension policies provide stable retirement income and give financial security to the policy holders. The main difference between life insurance and general insurance is that under life insurance the claim is certain and fixed, but in case of general insurance claim is uncertain, that is, amount of claim is variable and is ascertained after the happening of the event. Now we move on to the history of insurance in India. The history of insurance in India can be studied under two heads. The very first relates to history of life insurance. First, insurance company in India was Oriental Life Insurance Company, which came into existence in Calcutta in the year 1818. This company failed in 1834. In the year 1829, the Madras Equitable started its life insurance business in Madras Presidency. In 1870, British Insurance Act was enacted. After the enactment of this British Insurance Act in 1897, Empire of India were situated in the Bombay Presidency. In this era, mostly foreign insurance companies, namely Albert Life Insurance, Royal Insurance, London Global Insurance and Liverpool were doing good business of insurance in India. Indian insurance offices were facing hard competition with these foreign insurance offices. In order to regulate life insurance business in India, the first tertiary measure was taken as Indian Life Insurance Companies Act was passed. This act helped government to collect all the statistical data on the life and general insurance business being conducted in India by Indian and foreign insurers. This included provident insurance societies also. In order to effectively control the activities of all the insurers, Insurance Act 1938 was passed. All the earlier legislations were amended and merged in Insurance Act 1938. Principal agencies were closed down by Insurance Amendment Act 1950. At this time, there were large number of insurance companies which gave rise to high level of competition and few unfair trade practices. Hence, government decided to nationalize the insurance sector. On 19 January 1956, life insurance sector was nationalized by passing an ordinance. In 1956, 154 Indian, 16 foreign life insurers and 75 provident societies were nationalized and a new single unit was created, namely Life Insurance Corporation of India, by passing the LIC Act 1956. LIC enjoyed full monopoly till late 1990s. After this, insurance sector was reopened to the private sector. Now we are moving to the history of general insurance. General insurance service came in India with the establishment of Triton Insurance Company in 1850 in Calcutta by British. In 1907, a company named Indian Mercantile Insurance Limited was set up to conduct all types of general insurance business. In 1957, Insurance Association of India formed a General Insurance Council. In order to ensure fair conduct and sound business practices in general insurance business, General Insurance Council framed a code of conduct in 1968. Tariff Advisory Committee was set up. In the same year, Insurance Act was amended to set minimum solvency margins and to regulate investment. In 1972, General Insurance Business Nationalization Act was passed to nationalize general insurance business. 107 general insurers were nationalized throughout this act and were amalgamated to form 4 companies, namely National Insurance Company Limited, Oriental Insurance Company Limited, New India Insurance Company Limited and the United India Insurance Company Limited. The General Insurance Corporation of India was incorporated as a company in 1971, although it started its business on 1st January 1973. Thus, in 1956 and 1972, Indian insurance sector was transformed into monopolistic and oligopolistic state or public sector insurance industry. After adopting new economic policy in 1991, in the year 1993, government appointed Malhotra Committee under the chairmanship of R.N. Malhotra, former governor of RBI. The objective to create this committee was to recommend insurance sector reforms which can keep pace with the reforms initiated in the financial sector. In 1994, committee submitted its report. These were lots of recommendations with a noteworthy recommendation that the private sector should be allowed to enter into the insurance business. Committee also recommended that foreign company may be allowed to enter into insurance industry selectively and in joint venture with Indian companies. Now we move on to describing the meaning of Insurance Regulatory and Development Authority, that is IRDA. Following the recommendations of the Malhotra Committee report in December 1999, Insurance Regulatory and Development Bill was passed by Parliament. In April 2000, IRDA became a statutory body working with following mission statement. First, to protect the interest of the policyholders. Secondly, to regulate. Thirdly, to promote and ensure orderly growth of the insurance industry and for matters connected therewith or incidental thereto. So, on the basis of this definition of the IRDA, we elaborate the functions and duties of IRDA. Duties, powers and functions of IRDA are laid down under Section 14 of IRDA Act 1999. These are as follows. First, registering insurance companies and regulating them. Secondly, protecting the policyholders' interests. Thirdly, licensing insurance intermediaries and establishing norms for them. Fourthly, promoting professional organization in insurance. Fifth, regulate and administer terms and premium rates of non-life insurance policies. Sixth, specifying financial reporting norms of insurance companies. The next duty and function of IRDA is to regulate policyholders' funds by insurance companies. Eighth, to ensure that solvency margins are maintained by insurance companies. Next, ensuring insurance coverage in rural areas and of vulnerable sector of the society. Now we have to see composition of IRDA. Authority consists of 10 members team and all the team members are appointed by the Government of India. Team consists of first chairman, secondly 5 whole-time members, thirdly 4 part-time members. Now we are coming to the recent changes in the insurance sector. In August 2000, IRDA invited applications for registration. Foreign companies were allowed ownership of 26% only. In December 2000, all the 4 subsidiaries of the General Insurance Corporation of India were made independent companies and GIC was converted as National Reinsurer. In July 2002, Parliament passed a bill delinking the 4 subsidiaries from GIC. As per IRDA data today, there are 52 insurance companies in India, out of which 24 are life insurance companies and 28 are offering general insurance business. Life Insurance Corporation is the only public sector company in life insurance business. There are 6 public sector companies and insurance business in non-life insurance sector. This includes 2 specialized insurers, namely Export Credit Guarantee Corporation of India for credit insurance and Agriculture Insurance Company Limited for crop insurance. General Insurance Corporation of India is the sole national reinsurer. There are other stakeholders also in Indian insurance sector. These are licensed agent brokers, web aggregators, common service centers, surveyors and third-party administrators. Insurance Law Amendment Act 2015 has enhanced foreign investment cap from 26% to an explicitly composite limit of 49% with the safeguard of Indian control and ownership. Insurance sector is a massive sector with a growth rate of 15.20%. In financial year 2013-14, premium collected by Indian insurer was 3.90% of GDP. Now we move on to insurer solvency. Insurer has to maintain reserve for future insurance claim from policy holders. Insurance is a business which involves huge risk and any unexpected event can occur anything, giving rise to unanticipated higher claims. For example, natural calamities like Chennai floods, Uttarakhand flood or any earthquake, etc. In such a situation, if liability to pay claim is very high, then even insurance company can become insolvent. This will be very unpleasant situation for policy holders, insurer, insurance sector, regulators and even for the government. In order to protect policy holders, financial interest regulators compulsorily insist insurers to maintain some fund known as solvency margin. With an aim to avoid such financial crisis, it is compulsory to maintain solvency margin by every insurer company to meet unavoidable emergencies. According to IRDA, Asset Liability and Solvency Margin of Insurers Rule 2000, every life and general insurance companies has to maintain solvency margins. It is compulsory for life insurance companies to maintain 150% solvency margins. IRDA has issued guidelines to determine the solvency margin by all the insurers in India. First of all, the insurer company has to find out the value of all the assets and liabilities. Valuation of assets and determination of liability is done according to IRDA rules. The difference between the value of assets and liabilities is known as solvency margin. Subsequently, insurer company calculate the solvency ratio between the available solvency margin and the amount required. Margin is intended to take care of the unexpected liabilities. It is considered that an insurer company with the requisite solvency margin will be able to pay all its claims when they arise. Still, insurance is a business of risk which involves high degree of risk and uncertainty. Now we move on to the discussion of e-insurance. E-insurance has turned insurance to consumer oriented, as earlier it was product oriented. ICT has allowed insurance sector to go electronic and paperless and allowed cross-border transactions which offer services to exporters, importers, financial institutions and shipping companies. Life insurers were the first to move online and then automobile policy insurers were to go next. Today in India, large private sector big insurance companies have created partnership with popular technology companies and websites to display and offer their insurance product online. Online channel has enabled consumers to compare various policy products offered, their premium, maturity period and benefits after maturity, etc. All this helps consumer to save amount of high commission which was earlier paid to insurance agents. In April 2011, IRDA, the Insurance Regulatory and Development Authority in India, issued guidelines related to distance marketing of insurance products. This also governs telemarketing and online marketing of insurance products. IRDA has issued guidelines for insurers of e-policies and web aggregators. Now these insurers have to set up e-repositories for holding these e-policies. As per IRDA, web aggregators compile and provide informing about insurance policies of various companies on the website, and only licensed web aggregators were allowed to display insurance products and price comparisons of various insurance companies' products. Then we have to see certain warnings and penalties. Any consumer grievance related to regulatory perspective of insurance is administered by Consumer Affairs Department of IRDA. This department takes the issue with the concerned issuer for the resolution. IRDA may issue an advisory letter, a warning letter, or even impose a penalty on an insurance company which commits frequent or serious regulatory violations. Now we move on to the summary of what we have discussed so far. First, we have started the introduction or the definition of the insurance. Insurance is transfer of risk or loss of one entity to another entity in exchange of money known as premium. Then we have discussed insurance companies work as a financial intermediary. These companies collect funds from the society as premium and invest these large amount of premium in large development projects. Then we have seen there are many types of insurance and many insurance companies. All these insurers have to follow certain basic principles of insurance. There are 7 principles of insurance. These principles help to maintain integrity in all the insurance contracts. Then we have seen insurance is mainly of 2 types, life insurance and general insurance. General insurance includes health insurance, fire insurance, marine insurance, property insurance, rural insurance, vehicle insurance and travel insurance, etc. First insurance company in India was Oriental Life Insurance Company, which came into existence in Calcutta in the year 1818. In 1956, life insurance sector was nationalized by passing an ordinance. General insurance services came in India with the establishment of Triton Insurance Company in 1850 in Calcutta by British. In 1972, general insurance business was nationalized by passing a General Insurance Business Nationalization Act to nationalize the general insurance business. After following the recommendations of the Malhotra Committee report in December 1999, Insurance Regulatory and Development Bill was passed by Parliament. In April 2000, IRDA became a statutory body. There are 52 insurance companies in India, out of which 24 are offering life insurance and 28 are offering general insurance business. LIC is the sole public sector company in life insurance business, and General Insurance Corporation of India is the sole national reinsurer. IRDA has issued guidelines to determine the solvency margin by all the insurers in India. It is compulsory for life insurance companies to maintain 150% of solvency margins. E-insurance has helped the insurance sector to electronic and paperless and allowed cross-border transactions which offer services to exporters, importers, financial institutions and shipping companies. Any consumer grievance related to regulatory perspective of insurance is administered by Consumer Affairs Department of IRDA.